This presentation is designed to help you prepare for the MLO SAFE Test, a key exam for mortgage loan officers. We will walk through the essential topics, tips, and strategies to ensure you're well equipped to pass the exam with confidence. Whether you are new to the industry or looking to brush up on your knowledge, this guide will provide valuable insights and resources to help you succeed. Let's dive into the core concepts and important details of the MLO SAFE Test. Alright, let's talk about the closing process. This is the final step in getting your loan, where you sign all the necessary documents and the funds are dispersed. It's the moment when everything comes together, and you officially become a homeowner. The closing usually happens at a few different places: a title company, an escrow company, an attorney's office, or even a real estate brokerage office. The settlement agent, who acts on behalf of the lender, plays a crucial role here. They make sure you sign all the required documents and that everything is in place, like evidence of insurance and the closing funds. Now, let's break down some of the fees you might see. Origination charges are fees kept by the lender or loan originator. For VA loans, this fee is capped at 1% of the loan amount. Discount points are another fee. They're amounts you can pay to lower your interest rate. One discount point equals 1% of the loan amount. There are a couple of ways to buy down your interest rate. A permanent buy-down lowers your interest rate for the entire life of the loan. A temporary buy-down, like a 2-to-1 buy-down, reduces your interest rate by 2% in the first year and 1% in the second year, before returning to the original rate. Closing costs can include a lot of different fees: origination fees, discount points, real estate commissions, attorney fees, survey charges, title insurance premiums, appraisal fees, recording fees, document preparation fees, mortgage insurance premiums, and even VA funding fees. It's a long list, but each fee serves a specific purpose. Some loans come with prepayment penalties, which are designed to discourage you from paying off the loan early. These penalties must be disclosed in the loan estimate, LE, closing disclosure, CD, and the promissory note, so you know exactly what you're getting into. One of the key documents you'll sign is the promissory note. This is where you agree to repay the loan. It includes details like the principal amount, interest rate, payment amount, and any prepayment penalties. Unlike the mortgage, this note isn't recorded in public records. The mortgage document is what creates a lien on your property, securing the loan. It includes important clauses like the alienation clause, which deals with loan transfers, the due on sale clause, which prevents you from selling the property without paying off the loan, and the acceleration clause, which lets the lender demand full payment if you default. Deficiency judgments and exculpatory clauses. If you default and the foreclosure sale doesn't cover the debt, the lender might go after your other assets with a deficiency judgment. But if your loan has an exculpatory clause, the lender can't do that. It protects your other assets. Prepayment clauses come in a couple of flavors. A prepayment privilege clause lets you pay off the loan early without any penalty. A prepayment penalty clause, on the other hand, means you'll have to pay a fine if you pay off the loan early. For qualified mortgages, the penalty is 2% if you pay off within the first 3 years. For HPML Section 35 loans, it's 2% within the first 2 years. A defeasance clause requires the lender to send you a satisfaction notice within 60 days after you pay off the loan. An escalation clause allows the lender to raise your interest rate under certain conditions, so it's something to watch out for. A subordination clause is a bit technical. It allows a senior mortgage to take a junior lien position. This can be important if you're dealing with multiple loans or liens on your property. If you have a blanket mortgage covering multiple parcels of land, a partial release clause lets you sell some of those parcels separately and release them from the mortgage. Open-end loans, like a HELOC or reverse mortgage, let you take out future advances from the same line of credit and don't have an ending payoff date. Closed-end loans, on the other hand, have a set end date and an amortization schedule. Finally, a deed of trust is used instead of a mortgage in some states to secure the debt. The borrower, or trustor, conveys the title to a third-party trustee for the life of the loan. Once the loan is paid off, the trustee transfers the title back to the borrower with a reconveyance deed. Alright, let's talk about funding. Once all the conditions are met, the loan funds are dispersed to the seller and other parties involved. But if you're refinancing your primary residence, there's a special rule. The Truth in Lending Act, TILA, requires a right of rescission period before the funds can be dispersed. This gives you a few days to change your mind. The closing disclosure, CD, is a super important document. It must be provided to you at least 3 business days before the loan is funded. The lender has to keep a copy of the CD for 5 years. If there are corrections needed, some changes will require a new 3-day waiting period, like if the APR increases by 1/8% for fixed-rate loans or 1/4% for ARMs, or if the loan product changes. Minor corrections can be made without a new waiting period. If corrections are needed after the loan is funded, the lender has to provide a corrected CD within 30 days and refund any tolerance violations within 60 days. Buy-downs. There are a couple of ways to buy down your interest rate. A permanent buy-down involves paying discount points to reduce your interest rate for the entire life of the loan. A temporary buy-down, like a 2-to-1 buy-down, lowers your interest rate by 2% in the first year and 1% in the second year before returning to the full rate. The funds for these buy-downs can come from the seller or your employer, but you still need to qualify for the loan at the full interest rate. Right of rescission. For owner-occupied refinances, TILA gives you a right of rescission. This means you can cancel the loan before midnight on the 3rd business day after closing. You'll need to receive 2 copies of the right to rescind and 1 copy of the disclosure statement. If you decide to rescind, you just need to notify the creditor, and they have to cancel the loan within 20 calendar days. The settlement agent is the person or team responsible for preparing the documents, making sure everything is signed correctly, and completing the loan funding. They might send an estoppel letter to the seller's lender to get the payoff amount. If your loan is being transferred to a new servicer, RESPA requires a goodbye letter from the old servicer at least 15 days before the transfer and a hello letter from the new servicer within 15 days after the transfer. You also get a 60-day grace period where no late fees or penalties can be charged. Escrow accounts are used to hold funds for things like taxes, HOA dues, and insurance premiums. The maximum amount that can be collected is up to 14 months of escrow payments, 1 year plus a 2-month cushion. You'll get an initial escrow account statement within 45 days of settlement and an annual statement within 30 days of the computation year completion. If there's a shortage, you can pay it within 30 days or spread it over 12 months. If there's an overage of more than $50, you'll get a refund within 30 days. If the escrow account is canceled, you'll get a closing statement within 3 business days if you requested the cancellation, or within 30 business days for other reasons. An escrow holdback is when additional funds are collected at closing and held until certain repairs are made. This is to make sure the buyer or seller completes the repairs promptly so they can get the money back. At closing, you'll sign several key documents. The promissory note is where you agree to repay the loan. The security instrument, either a mortgage or deed of trust, secures the loan to the property. The deed is signed by the seller to transfer ownership to you. You might also sign affidavits and declarations, like stating that the house will be your primary residence. The closing agent will make sure all these documents are recorded in the public record. Funding process. In a purchase transaction, the buyer provides the down payment and closing costs, which go to the lender and then to the seller. In a refinance transaction, the process is a bit slower because of the 3-day right to rescind for principal residences. This gives you time to make sure everything is in order before the funds are dispersed. Congratulations on taking the next step toward becoming a certified mortgage loan officer. We hope this study guide has provided clarity and a solid foundation for your exam preparation. Remember, success comes with dedication and practice. Stay focused, keep reviewing, and you'll be well on your way to passing the MLO SAFE test. Good luck with your studies, and feel free to reach out if you have any further questions or need additional resources. Stay confident, and you've got this.